Hello, everyone. Thank you for joining us today for this webinar on Road Ahead for Equities. We are pleased to have Neelesh Surana with us today. Neelesh is Chief Investment Officer at Mirae Asset Investment Managers India, and he will basically share his views on the markets. And the structure of this webinar is basically to, first, obviously, I'll start with a brief market update, followed by our managed portfolios offering and how the portfolios are positioned. And post that, Neelesh will share his views on the markets. And after that, we will have sufficient time in hand to take questions from the participants. So that's basically how we plan to spend the next 60 odd minutes. And before I get into the markets, just a quick brief on Morningstar's investment management group. So I'm part of this investment management group, and we are basically operating from three regions. We have got three hubs: Americas, EMEA, and Asia Pacific. Collectively, we basically look after approximately $265 billion worth of assets under management and advisement. And we have got a strong investment team of 95 plus investment professionals who come with a varied experience in terms of investment analyst or portfolio specialist and portfolio managers and so on. With that, I'll quickly come to what's happening in the market, what the current environment is. I'm sure everyone is glued to the market these days, given the kind of volatility that it has seen lately. It is exciting and it is unnerving for investors at the same time. If we look at how the markets have performed in the last 6 months to 1 year kind of a time frame, Indian equities have definitely seen some bit of correction, but on a relative basis, relative to the global markets, definitely the correction has been kind of limited, particularly if we compare India to emerging market and China in particular, where on a 1 year basis, China is down roughly around 37 odd %. And that is largely due to the regulatory restrictions which have come in on the Chinese tech giants, and plus the fresh round of COVID has also derailed its growth prospects. So definitely EM and China in particular is seeing a lot of correction. Along with that, obviously, with whatever is happening around Russia, Ukraine, and resultant spike in commodity prices, concerns around inflation, and an aggressive monetary policy tightening, which is kind of underway by major central banks. Definitely, equities have seen a lot of heat because of all these factors. US in particular, or high growth tech stocks, Nasdaq 100 has seen a much sharper correction on a year-to-date basis. It is down roughly around 23.5% in INR terms. Obviously, in dollar terms, it is down roughly around 27, 28 odd %. And this has basically created a fair bit of gap between the growth index and the value index. And like you can see out here that on a 6 month basis, the growth index is down roughly around 23.5%, whereas the world all country world index value index is down just around 2 odd %. Apart from that, Europe has also seen another round of volatility and correction, and this is largely to do with their heavy energy reliance on Russia in particular. So that is something which has also seen a fair bit of correction. And like I mentioned earlier, definitely in commodity prices has been one major factor lately. And not just what has happened post the Russia-Ukraine situation, but after March 2020, as the economies started to open up from COVID, and given that there were a lot of supply constraints and disruption as well, that basically led to a sharp rise in global commodity prices, not just crude oil prices, but also industrial inputs and food prices and so on. And as a result of that, it basically triggered a lot of concerns around inflationary pressures. In fact, major global central banks started to take a note of inflation, immediately as it kind of was moving beyond 6% kind of rate. US basically saw in the month of April inflation, going up to around 8.3%, and definitely they have the US Fed has already announced a rate hike, and what do they plan to do in terms of by the end of 2022 or 23. So is true for even for UK and Eurozone in particular. Obviously, the inflation numbers are pretty high. In fact, last when it was at these kind of levels was roughly around 40 years back. So after almost a 40 years period, these markets are seeing significantly higher inflation rate, and definitely this is going to trigger and much aggressive reversal in the monetary policy settings that these central banks have been following. And this is true to an extent also for India, as we all know that around COVID, the Reserve Bank had cut down policy rates significantly. It had brought it down to 4%. But now, again, given the kind of pressure inflation is putting on the economy, the Reserve Bank took a note of it, and in fact, it did announce an off-cycle monetary policy meeting where they basically hiked the policy rate by 40 basis point. They also hiked the cash reserve requirement ratio by 50 basis points. So, and the broad expectation now, that the market is holding is that the policy rate, at least for India, is something which is going to be around 5.25 or 5.5%. That is kind of viewed as a terminal rate, and in near term, that is where the policy rates are going to move. And this has not just the entire geopolitical situation or the inflation situation that we are seeing worldwide. It has not just impacted equities as an asset, but it has also impacted debt markets, fixed income markets. We have seen, globally the yields, and then what you see out here is the 10-year, benchmark GSEC yield for different countries, and clearly you can make out from this chart that around the start of the year we have seen yields spike up quite a bit. In fact, in case of Germany, the yields were in negative territory. It were below zero, and now it has bounced back to the positive territory. And even in case of India, we have seen a sharp rise in bond yields. Definitely, it is kind of not a favorable situation for an investor who has got into the bond market in the last 1 year or so. But at least from a new investor standpoint, I think the current term spread which the yields are offering is slightly getting attractive as yields keep on moving up. And with that, I'll just briefly talk about Morningstar's managed portfolio proposition. So, when we look at the markets, what is it that basically drives our view, and how do we basically maintain our asset class positioning? So, what essentially we try to do is follow our 4-pillar valuation-driven asset allocation approach, and these 4 pillars basically help us build views and conviction across markets and across assets, and help us to accordingly position our portfolio. And the first of that obviously is absolute valuation, where basically we try and look at the current valuation of the market relative to its own history. This gives us a perspective whether relative to its own history, whether the markets are currently overvalued or undervalued. And if I give an example of Indian equities right now, if we look at the current market valuation and versus the fair market valuation estimate that we have, definitely despite the correction so far that we have seen on a calendar year to date basis, markets are still looking slightly overvalued when compared to its own history. The second pillar that we focus on is relative valuation. And the idea to do this is to basically actively look out for opportunities in the global markets as well. So as a part of our opportunity set, which we use to manage our portfolios, we not just focus on Indian equities, but we also look at international markets, US, Europe, UK, emerging markets. And the purpose of doing this is to identify where the opportunity lies and where we can basically take an active valuation driven call. So this particular pillar helps us to understand whether Indian equities are relatively better valued as compared to international markets or not. And at the moment, Indian equities are relatively better placed as compared to US equities, but they are slightly unfavorable when we look at in comparison with Europe and emerging markets in particular. The third pillar basically is a contrarian indicator where we try and assess what signal market is basically giving based on three factors. One is momentum, where we basically track the short-term market performance. Second is flows, where we try and assess the foreign flow coming into the Indian markets. And third is expectations, where we look at the consensus earnings estimate. And at this point of time, on an aggregate basis, putting all three factors together, none of the factors basically indicate optimism or pessimism at this point of time. In fact, the levels are close to its neutral level. In fact, it has improved with the kind of correction that we have seen lately. And the fourth one is fundamental risk, where we try and assess what is the permanent loss of capital, what are the factors that could basically trigger permanent loss of capital, and then at least right now at this point of time, what we have observed is that the current operating leverage, financial leverage and revenue cyclicality that Indian corporates kind of are basically looking at, the risk element out here seems to be slightly limited. Obviously, having said that, there would definitely be some unknown risk elements which are kind of difficult to factor in. And the idea is to build conviction using these four pillars, not just for Indian markets, but also for global markets. So what you see out here is our global conviction for different assets and markets. On the equities, like I was mentioning earlier, US, despite seeing some bit of correction lately, it is still it still carries a low to medium conviction level, and this has got more to do with the market valuations at which it is basically trading at. Although the current correction has kind of made it slightly more attractive as compared to what it was around the start of the year. On the equity side, the other area where we are seeing some strong momentum or return estimate building up is emerging markets, and that is largely to do with the kind of valuation correction that the Chinese equities have seen. We believe that emerging markets is something that would basically add a lot of value to investors over a slightly extended time period. On the fixed income side, again, emerging market debt in local currency term is something which is offering a high spread relative to developed markets, and that's where we are seeing a lot of attractive opportunities. And how do we put all this together in terms of the proposition that we are offering to the investors? So out here, for the Indian investors, we basically have 4 multi-asset strategies which we offer through our PMS platform. and these are multi-assets in a way that it invests in Indian equities, international equity, fixed income as well, and the underlying exposure is built through direct share class of mutual funds. And like you can see, the four multi-asset portfolios are basically constructed or offered to the investors to kind of meet their particular risk and investment risk appetite and investment horizon, or the time frame that they are basically looking at. So each and every investor is kind of classified as per a particular a risk profile that this portfolio is linked to, and accordingly a portfolio is recommended for them to basically get along the journey of long-term wealth creation. The first three portfolios out here basically are offering exposure also to international equities along with domestic equities, like you can see from the chart out here. Whereas the fourth portfolio is domestic asset only portfolio, where the underlying is domestic equities and fixed income. Active balanced portfolio is something which would typically have an allocation of roughly around 50% to equity, 50 to debt. Growth would have basically around 70% exposure to growth assets, which is equity, and then roughly around 30% to fixed income. Aggressive would have around 90% to equity, 10% to debt, and aggressive plus is 80% equity and 20% debt. So in terms of the current positioning across the portfolios that we basically have, and what you see out here is the active aggressive portfolio, the asset class exposure, the current asset class exposure versus the benchmark. And a few things to highlight out here is that overall on domestic equities, we have been kind of slightly underweight to the benchmark levels. In fact, the current allocation is also roughly around 2.3 2.5% lower than what the benchmark allocation is, and some of it is coming in from large caps and to an extent also from mid and small cap. Apart from domestic equities, on the international equity side, we are underweight US equities, whereas we are kind of slightly overweight Europe and emerging market, and some bit of the underweight allocation on equities put together is right now parked on the fixed income side, particularly in cash and in the medium term GSEC segment, debt segment, and in particular, where we have identified some attractive opportunities and accordingly build position out there. And obviously, as and when market would offer us opportunity based on valuation correction, definitely this overweight allocation on the fixed income side is something that will be utilized to build allocation on the equities, not just on Indian equities, but also on international equity front. With that, I would now request Neelesh to share his views with the participants and talk about his investment style. Over to you, Neelesh.
Thanks, Chintan. You sort of very comprehensively covered the topics which are engaging investors' mind as of now. So I would try to avoid duplication of that. That said, would not totally agree with the view. Whenever there are two panelists, there are bound to have some sort of differences. So we remain quite positive and constructive on the equities. And I was seeing just glancing the questions in the chat box. Someone mentioned that when there is blood on the street, shall we buy more? I think it's literally closer to that. It's not exactly like March 20 or so, but markets which were reasonable at the start of the year and not so cheap, but has now clearly become attractive. So with that, I have about 15-20 minutes. So I would just recap what Chintan sort of, and additionally in terms of what are the driving factors impacting the equities, and take both a medium-term view, which is 3-year view, and also we take a more very quickly recap a 5-10 year view in terms where the country is headed, economy is headed, and therefore equities and wealth creation opportunity would be. So this is sort of the agenda of discussion, and I'll just move fast in few slides and focus more on the relevant one, because otherwise it will take more than 20 minutes. So basically, we will start with the two headwinds, and Chintan did mention. So basically, one obviously is there is a regime change or end of an era, if we were to say, on the US interest rates and global interest rates. Globally, we are seeing low interest rate regime no more there, and it's basically because of inflation. And second is the factor which is impacting the country most in terms of various parameters, which is high oil prices driven by the war. We would look through these through sort of headwind and see that now why net the summary is that normalization in earnings is it sort of intact. I think I like to call out some 5-6 factors, and each of these, if you look through interest rate lens as well as high oil prices, by and large, the glide path is they will be able to mitigate and come out of it in terms of the directional being there, and it's not be disturbed. So while these are challenges, but it's not that it is impacting significantly the medium-term outlook. Short-term, yes, maybe 1 or 2 quarter numbers would be erratic, but longer term, I don't think so. It will be impacted. And we'll touch on the housing revival. I'm not going in a particular order, but we'll touch on what's the buoyancy, huge buoyancy we are seeing in the IT sector and its impact on consumer demand. We'll touch on the China plus one PLI opportunity. It just started. So, I mean, the base is so low, it has only sort of things would improve. Also, rural economy revival, consolidation thesis, and net all put together, the earnings trajectory would be sort of by and large not intact. So it's by and large intact. And thus, the correction in these stock markets, what we have seen recently, we are at about I think there is an error here, about less than 16 times FY24, 15.5, 15.8 times, which in our view is reasonably attractive. And I'll come to that. We'll also touch upon the flows and how do we see or that, and also in the longer term story. Very quickly, I mean, oil remains the most important sort of moving part for Indian economy. I mean, for every $10, there is an impact on the retail price of fuel. There is an impact to the government. Basically, there is about $14 billion impact, and that has to be shared by government, consumers, and companies. And that's about 0.4% of the GDP. Only thing is today, things are slightly better. A, we still have very strong forex reserves. B is that we have strong buoyancy in not only manufacturing exports, agri exports, but most importantly, IT exports is north of $200 billion. So the ability on the current account side is much more cushioned. That's why we have seen relative to other countries, our currency has been reasonably okay, YTD. And just to conclude on the impact, and obviously there is an impact on the inflation, direct and indirect in terms of CPI and also WPI. So, I mean, its sensitivity to oil was there for India 10 years back also, and it continues to remain. So that remains a risk. It remains a risk if someone is of the view that it goes to 140, 150 and stay at that. We are of the view that worst case would be around current level 100 plus minus 10. And as I said, that the tolerance levels has increased compared to, let's say, taper trend from in 2014, etc., for the factors which I sort of mentioned. Very quickly on interest rate, it's a very complex subject. I'm not sort of in full grip in terms of to make a judgment on it. So we can say what could obviously increasing, and just to revisit why the increase may not be as significant as feared. Obviously, one is that globally interest rates have increasing, US but in particular. But the point is we need to differentiate. US, the inflation was 1.5 around, and it moved to 8.5. So it's and in Eurozone it's 0 to 0.5, moved to 6%. So it's literally a huge sort of urgency to tackle the inflation given the pace of increase. They've never seen 8% sort of inflation. In India also inflation has moved, but we are talking of 4-5% moving to 7-8%. So there is a difference between the two. Second is the inflation impact because of oil. As we said that oil is supply led, and all of us know the reason. And we can make, I mean, you have to make certain assumptions. We can make an assumption, then even after 1 year, the war would not be there. So to some extent, the supply would be sort of restored. And of course, high borrowings from the budget also would help put pressure in the system. As I said, there are few factors which are supportive, while RBI has taken some action, maybe slightly late or so, but they are also over a period of time look at factors which should not disturb the growth. Second, there is surplus liquidity. Post the COVID scenario, we had excess liquidity, although the extent of excess liquidity has come down, but we can't have very high interest rates and surplus liquidity in the system. Lastly, globally, the central banks are actually using this lever to increase the interest rate. Demand will come down. So global demand will come down, global commodity prices will come down. Therefore, imported inflation in India would sort of come down. And so these are the pros and cons on the interest rates. If you look at last 40, 45 years, in terms of whenever there has been aggressive increase by US Fed, I mean, domestic markets have not much of linkage to that. Let me sort of come to why the country economy would be able to sail through these two challenges. And as I said, we are assuming that in oil would be around 100 plus minus 10 or so, and now taking 140, 150 assumption. I think there are few sectors and few factors which are on a bottom-up basis turning around for a different reason for each sector. So we'll revisit that. So housing is going through one of the best cycle in terms of the volume traction of house owners. So while government capex is doing well, corporate capex is missing, household corporate capex has sort of accelerated. Banking is doing pretty well. It's in very good shape because there are no NPAs. Corporate NPAs were solved pre-2020. And we have not seen retail NPAs sort of formed during the COVID wave as much as feared. Telecom has a pricing power because multiplayer is now consolidated into two and a half player. So the profitability pool of that sector is increasing. Metals, we are seeing again once in best few decades sort of scenario. This may not sustain, but it is driven by, in addition to supply issues, which is near term, the structural issue is China decarbonization. China is literally 40-50% across all commodities. So they want to, in the longer term, decarbonize the economy, which means the supply would be structurally be curtailed. So that's advantage India. Many metals, India is the best place to produce. Let's say case in point is aluminium. Nowhere in world you have both alumina and coal at a distance of about 500 kilometers. So India has a natural advantage there. Even in steel, we have a decent advantage in terms of packing order because of availability of both iron ore and coal. So that's doing pretty well. IT, as most of us would have their friends or contacts, is doing reasonably well. IT attrition is very high. That means IT's salary hike is very high. That means it's not so positive for IT companies, but it is very positive for consumer demand. They used to get about 4-5% salary hike. This year is closer to 15% plus. And we are talking of $100 billion of base. So you have additional, it's like a dole out, literally. So this is seeing very strong demand generation because of COVID and demand fulfillment because of innovative way of work from home. Rural will touch upon, and overall corporate profitability. I think corporate balance sheet is one of the best in last many years. If you look at total debt to equity of various sectors, be it textile, steel, cement, at an aggregate level, it's about 1.5, which is much better than what we have seen last few decades. So very quickly, I will not spend too much sort of time on each of these. So housing cycle, as I said, is turnaround. Rural, I think, is also would do well because we have 4 years of back-to-back good monsoon, assuming that the fourth year, the current year also, only after the rains we can say in terms of distribution and quantum. Rural was impacted by the second wave. So that migrant jobs are sort of coming back. We have, I think the silver lining of this unfortunate war is that commodity farm prices are high. Of course, we had loss of wheat crop, but there will be agri exports will be good. Even last year, agri exports were pretty solid. And then we have multiple support from government because of the various program. And next year, again, there is an election, etc. So rural, I think would, which is a soft pocket now, would move around. IT, I have already sort of covered. China plus one is not a jargon. I think it is a very serious effort by the government to capitalize, and the manufacturing over the next 3-5 years will improve because of three things: multiple reforms, PLI and China plus one tailwind. I'm not going in detail because of paucity of time. And this is a factor. This is not a sector sort of thing. A general trend of what we are seeing over the last multi years, 4-5 years, is that strong companies are getting stronger, weak is getting marginalized or weaker. And this is across all sectors. And this is advantage organized sector. This is advantage top 2,000 companies, listed companies, within that top 500 companies, then within that top 100 companies. And across sector, we are seeing that it is the strong is getting stronger. Generally, strong is mid-size or large size. And this is courtesy, demonetization, tax reforms, the digital ecosystem, and pandemic wave 1, wave 2, wave 3. It's very difficult for a relatively weaker player to handle all that, commodity price trends. And what we are seeing is the unorganized sector is getting marginalized. And so it is not reflecting in GDP. For example, plywood is a 25,000 crore industry, 20% is organized, 80% is unorganized. So if we see that the industry is degrowing by 5%, but that 20 is growing by plus 20 and the 80% is sort of degrowing, something like that. And across all, even in larger business, even in banking, we are seeing top 5 banks much better both on asset and liability side. So net, what we are seeing is the corporate profitability reached a trough in FY20, which is pre-COVID, and it would recover in FY24, which is first year of full COVID. I'm not taking FY23 because FY23 will be erratic, impacting by the commodity prices. And this is just a Bloomberg consensus number that the pool of profit is moving from 350,000 to 8 lakh. I think it's broadly in the pocket, many areas, despite these two events, which will impact consumer autos in the near term. But in there, as I say, FY24 estimate, the consensus estimate, because bank is in a very sort of, it's in the pocket, they're not impacted by the retail and BS. Telecom, I mentioned that materials is in fact much more conservative number. IT is very steady, and there are a couple of names which turn around the sort of profit. So we are talking of literally 1,000 plus EPS earnings per share. Is if you look at the Nifty, we are talking of if Nifty were to be a stock, then the earnings is moving from 450 to 1,000. 450 pre-COVID FY20 to 1,000 post-COVID FY24. And when we look at the PE multiple, which is about 15, say 16,000 is the level, then divided by 1,000, so it's about 15.8 or almost 16 times. It should be seen in the lights of that, are we normalizing in the earnings? And what are we seeing as a longer term interest rates? The markets are a function of the macros, economy, ultimately that's earnings. And they are in the medium term or near term also function of flows. And flows, as you can see, blue bar is domestic, blue bar is the FIA flows and light blue bar is the domestic flows. What's interesting in FY22, which is April to March 22, is that FIA sold heavily, minus $20 billion, a really very big number. I think the previous number was in FY9, FY0 in 2008. And again, even YTD current year, they have sold very significantly. But for the amount of selling, markets have not fallen because domestic investors, and you have advisors here and retail investors, they have participated because of SIP and mutual funds are getting inflows, which is very good, very healthy. I remember post-global crisis, in the next 5 years, FII bought 6 lakh crore, domestic moved out minus 60,000 crores. So now the bucket has changed. It is healthy because you would have more healthy sort of views across in different pockets type of sort of investor. By the way, domestic money is reasonably sticky because of SIP nature in terms of the time frame. Very quickly, I will take 2-3 minutes, 3-4 minutes more in terms of the big picture. Let's look back from take a 10,000 feet view. I think the country is beautifully positioned to grow sustainability and the longevity of the growth, and it is driven essentially by demographics and the potential in infrastructure. All of us would know about the demographics. We are the youngest with a median age of 28 years. The age cohorts are favorable. Urbanization trend is taking place. Per capita GDP would increase over a period of time, and jobs will be supported partially by some of the initiatives like manufacturing or the advent of gig economy, which is more formalization. And infrastructure, government has spent 110 lakh crore national infrastructure pipeline. So it's sort of more bottom-up sort of potential. And of course, huge reforms have taken place in this country, whether it is GST, RERA, NIP, the tax cut, the Null Sechal program, multiple and digital sort of reforms. I think we have never seen a period where many of these 4 or 5 year reforms were culminated in terms of the growth, because just before things were improving, we had COVID 1, 2, 3, and now the global sort of macro thing. But all this has been painful reforms. I think the pain has been taken care, and the gains from that has yet to accrue. I think I would skip this section for the interest of time, but we can take it in the Q&A in terms of sectoral preferences. Yeah, and that's what the last section was in terms of the investment approach and sectoral preferences. So I think I've taken more than 20 minutes. I'll pause here and pass it on back to Chintan and Abhinav.
Sure. Thank you, Neelesh, for sharing those insights. We do have some few questions from the participants, but before I get onto that, a couple of questions from my side. You spoke about the reform measures and the kind of impact that it is expected to have on corporate profitability on a slightly medium term basis. But don't you feel that the kind of rally we have seen post COVID, most of these positives in a way are kind of priced into the valuations where markets are trading at? In fact, some of the the risk factors which are now a lot more prominent, these aren't truly well priced in right now. What's your sense across market cap on this?
Sure. No, a couple of things. One is, I mean, if you would ask this question at the start of the calendar year, I would have agreed that, okay, markets are, I mean, we are saying that 1 year may be lost or something like that. But since then, markets have corrected. So that is one. I think valuations are reasonable. I mean, reasonable to cheap, in fact, in that zone. Earlier, it was reasonable. And second thing is, we have to look at the time frame. If the time frame is 3 to 5 years, then 1 year here and there doesn't make much of sort of difference. So if your question is specifically if at the start of the year, was the market pricing in some of the benefits? Yes. But with this correction, I think markets are reasonable to attractive, and one can expect definitely low teens, 13-15% compounding over a 3-5 year point. You are right. Post-COVID, like globally, India also has got re-rated, and there has been froth in the system, some pockets and all that will get course corrected with higher interest rates. But as I said, structurally, there are two things. We are at the trough of the economic cycle. Pre-COVID, we were at that. So we would mean revert and probably stabilize above that. That is one thing. And second is in the medium to longer term, because equities, one has to look at a minimum 3 years, not that returns don't come earlier. In the medium to longer term, I think one of the reasons why markets have corrected is FII selling, which would come back. FIIs will come back over a period of time, because as the dust settled in terms of this war and the lower high interest rates, when you look at globally, there is no other country which is as attractive as India in terms of the drivers to grow and the longer term sort of potential to grow. So I think FIIs will come back in terms of flows, earnings will recover. Of course, near term could be volatile because of these two macros.
Okay, yeah. So that the question on earnings is something which was kind of playing on my mind as well. That the factors that would obviously have a direct impact on the earnings as the raw material or the input price pressure, and definitely we are seeing a lot of that building up in the discretionary space in particular. So do you think the kind of earnings estimates that the market has at this point of time would see some major derating, and obviously it will have an impact on the market valuations as well? Or do you feel that the earning estimates which are out there, and to an extent the estimates that you had also shared a few minutes back would not largely be impacted because of whatever is happening at the macro front?
Yeah. So, I mean, this is a good question, but as I had shown in the presentation, that 1,000+ Nifty earning was there even at the 4 months back, when both quantitative tightening and the panic on the inflation as well as war was not there. So that is one. Second is only thing is the nature of the earnings within that is changing. Commodity producers will get more sort of upgrades, and consumer, as you rightly said, discretionary, etc., will be impacted. Let's look at it in 2-3 ways. One is those who are producers, they get benefited. So it will be for them neutral to positive. Those who are consumer, you can bifurcate into B2C businesses, B2B businesses. What happens generally in B2C businesses, which is the levers of the world and consumer staples, if there is a big shock on inflation, which is like last 30, 40 years, we have not seen such shock of inflation, it will take few quarters of them to pass the prices of soap, toothpaste, etc. It will not be done at a one go. But if you're looking at today point in time, it appears that there is a margin pressure. But they are taking price hikes over a period of time. So the point is, it will be passed on over next few quarters. It's not like some 8-10 quarters. It will be say 4-5 quarters. Everything would be sort of passed on. Even in B2B businesses, over a period of time, it doesn't see when the inflation is so sharp, so soon, it is not possible for consumer to overnight pay high prices. So it takes, I think we are in that period where there is a margin pressure and the pass on is taking place slowly. But momentarily, because there is a margin pressure, it is reflected in the P&L. So I think market will look through such businesses, their momentarily compression in the earnings, and we'll look at the medium term, just like you look at it the other way around also. If let's say after a year, because inflation is YOY, after a year, suppose crude comes down, will market optically price the higher earnings because of margin expansion? No, similarly like that. So I think that while the quality of earnings is slightly deteriorated, but aggregate basis, we are talking of 1,000 plus earnings for Nifty. So that is intact. I mean, we are looking at an aggregates here. So, and also, I mean, some of these factors which you mentioned, the stock prices have corrected. So it's not that they're not correct.
Okay, and sure. So obviously, some of these questions also kind of concur with the questions that the participants have put across in terms of the market valuations and what's the take on different segment. And one of the question is around the kind of themes or sectors that you are clearly focusing across most of your strategies, most of your equity strategies. Could you please throw some light on that?
No, so we are basically from a portfolio construction is more from a longer term lens. So we're looking at high quality businesses in terms of two angle, growth and the quality of growth as defined by return on capital employed. So many of the businesses, particularly which have now become cheap because of market correction, because of FIA selling, looks interesting. Among the larger names are banking is one large pocket, many large stable corporate franchise, the larger ones. As I said, stronger ones, not necessarily large, but they happen to be large in terms of the franchise. They are looking very interesting. Insurance has corrected, is looking sort of interesting. We see a lot of consumer names subject to valuation. Some of them are still expensive, but those who have corrected, be it particularly in autos, have corrected quite a bit. That looks autos. The point is, we were talking about, I forgot to mention one of the factors that why things would improve. The auto, the base is so low that only way up is forward is up. I mean, you have selling cars, the country is selling less car than what it was selling in 2017-18. We are selling half of what commercial vehicle is, even two-wheeler base is low. So base is low, and it was obviously every time impaired by multiple things in terms of regulatory norms and COVID, etc. So that would sort of do well. Staples also, where the price of corrected is sort of do well, because your earlier question that optically margins may deteriorate, but longer term it may strengthen, and rural will do well. So across sectors, we are seeing that metals also balance sheet has been very solid. So we can take a beyond the commodity price look in some of the names. IT is one which is slightly on the higher side, although it has corrected. So it's more in the hold zone.
Okay. And when it comes to investing, definitely there are two aspects of it. One is the fundamental knowledge of investing, and the other is the behavior side of investing. And typically what we have seen is that at times, if investors can get the fundamental side of it right, they typically get the behavior side of investing absolutely wrong. Maybe one classic example of that could be the kind of fund flows that we have seen getting into US equities. after having sharp rally for the last 10 years, for a decade or so, the correction that it is seeing right now, the Nasdaq 100 in particular, which is down roughly around 28% definitely, it will have an impact on the investors' mindset and then the kind of approach that they are taking when it comes to looking at particular market. What would you advise to investors who are looking at markets purely from its past performance standpoint and kind of not focusing too much on the market valuations?
Sure. So I would probably sort of cut across in terms of probably audience, those who are directly investing and those who are investing via products like mutual fund, which is beautiful product. I think on mutual funds, I think the ecosystem has matured. I see a lot of factors, manufacturers, regulators, agencies like UA, and the investor themselves looking on a SIP for 3, 5, 10 years. And then with the experience, only thing is the newer set of investors who have come in last 1.5 years, they need to be tested for the experience. But if you are hand-holding is done for 3, 5, 10 years, I think the experience will be good and the conviction will increase. For those who are investing in stocks, you are right. This is much more applicable, that the time frame, mind frame is very important. I mean, it's important when you buy a stock to be a full owner of business. Look at it, you're a part owner, but you think as if like you're a owner of the business rather than looking at a stock. That changes the time frame and mind frame, because if you are a business owner, you may not worry about US 10-year every day, right? You'll focus more on your business, longer term drivers, potential, etc. Then the lot of noises, the TV, media, and other sort of throws, and now obviously a lot of other media sources throws. So people try to dissect each and every sort of macro and how will it impact, more so from a near-term point of view, next year, next quarter, something like that, which is not right. I think it's important to look at as Benjamin Graham said, that investing is most intelligent when it is most business-like, and Buffett once said that it is the 9 most powerful words ever written in the history of investing. So that has a lot of meaning. It's a simple sentence that you have to have a business-like approach. If you have a business-like approach, then many of the noises may not be so appealing. If you're a full owner of business, because you can't do much, you are taking a longer-term sort of call, and that's what that time frame, mind frame, I think, Chintan, is probably with experience people get it, maybe the hard way. So the new people who have come to markets, I mean, everyone has gone through some amount of grind, and then over time you have to sort of see it. Mutual fund, I think it's the ecosystem is extremely mature, but for new investors in stocks, I can't say with that confidence.
Okay, fair enough. There are a couple of questions around rupee in terms of what's your take on the way it is performing right now. I mean, within the emerging market basket as such, and in terms of the kind of impact it will have, not only in terms of the increased import bill, but also whether to what extent will it help us in improving our exports and so on.
Yeah, so one is, as you rightly said, is to be looked at relative basis rather than absolute basis. And that's one. Second is, I think, see, it's a complex subject, so I'm not an expert in some of these macro things, but I would say that our ability to handle the both the crude and more importantly, the interest rate tectonic shift which is taking place globally is much better because of our strength of the economy and also on the forex side. So with reserves, including forward cover of almost $640–650 billion, very, very high reserves in terms of number of days of import cover, as well as the current account being in reasonable shape. So we will have deficit, obviously, FY23, but it will be about -2% or so, which is fairly manageable given the challenges. So I would say that on its own, because US also inflation, ideally rupee should depreciate between the inflation differential, but US also the inflation is high. So momentarily, let's not draw too much of conclusion. Let the dust settle over a period of time. After 1 year, after 6 months, the inflation trajectory itself will be different because it's a YOY number, including US and in India, the drivers will be different. So broadly, I would say that it has shown quite resilience. I mean, recently we have seen some sort of depreciation. I don't see that that either ways there are sort of factors which could sort of deteriorate or lead to significant depreciation or appreciation, because while there are factors which could lead to depreciation because of the oil prices and a differential in interest rates, I think India is different in terms of its strength, and also we don't have any pressure that there will be outflow of foreign debt because the base is so low. I think it's about 35-40 billion dollars.
Okay, and so you did throw some light on the inflation in terms of how it would kind of come down with demand stabilizing, but again it can work the other way as well, in terms of inflationary pressure can actually have a much stronger impact on the consumption demand, and rather than normalizing it, it could basically kind of bring it below the normal level. So from that standpoint, again this is one of the questions from the participants. Would you kind of look at that particular factor having a much stronger impact on the near-term market valuations?
Yeah, so Chintan, I mean, I'll come to the answer to this question. But I said there will always be walls of worry, and there is no one would have perfect answer to many macro things. Who would have thought a year back there will be quantitative type thing? Who would have thought that these sort of inflation would happen? Similarly, we can't exactly predict, and definitely I'm not sort of well equipped to comment on many of those macros. That's because, as I said, if you are a full owner of business, some of these things are in the medium term would sort of doesn't impact as much. But yeah, I mean, see, inflation, as I said, the drivers are different. If in US, if you're suggesting that, what I was suggesting is in the near to medium term, if the worry was that the inflation is because of strength in the economy, particularly labor inflation was that they were worried about, and also the commodity inflation. With the increase in interest rates, demand would subside, which would, if that lever were to take place, which it would, I mean, if central banks are right, that would mean that your pressure on commodities would sort of ease. That is what I was sort of hearing. So that is one angle to it. The second angle is the supply side disruption caused by the coronavirus. We have seen, let's say, port sort of situation, congestion in China still being erratic. We have seen what's happening, huge things which have happened because of the war, right? Particularly on the food side and the metal side, because Ukraine plus Russia was a significant player in the global trade. So again, these things over time, we are assuming that it should sort of normalize. So one is the demand angle because of the lever of interest rates. Second is the supply sort of angle. It's fairly complex sort of a thing. What I was alluding to, that it is a big thing. It is, as I said, these are like very significant sort of thing. It is just that when you look at it dispassionately and genuinely, when you look at it, you would realize that some businesses have ability to pass on the inflation and earn increase of more than inflation as the pricing power, what we say. So good businesses, and that's why it is said that equities are a hedge against inflation in the medium to longer term. But yeah, near term, if you ask on a point to point quarterly basis, it could have come.
Okay, and another interesting numbers which I shared in one of the slides earlier was around global growth versus value market performance, and value has definitely seen a much better performance versus growth in the last 1 year. Now obviously that's global, but when it comes to Indian markets out here, value to a large extent is reflected through the PSU entities and in particular. And what's your sense in terms of the opportunities that are kind of available in either of these segments, in terms of where are you currently kind of skewed? Is it more growth, is more towards growth, or it is kind of balanced, or it's more towards value?
Sure. So first of all, I mean, as you rightly said, I mean, just to put in context, these things would be more relevant 6 months back or a year back. because a year back you would have same government entities or power utilities or tobacco company. These were in value zone, and growth was at a was going bit berserker in terms of valuations. You are right. I mean, globally it has been corrected. Even in India, it has sort of corrected on a relative basis. So a few points on that. First is we obviously not try to overpay for growth. So growth at any price is a no. I mean, there are risks. There are when you I didn't run through the investment sort of philosophy side, but there is always risk to wrong business selection, wrong management selection, and overpaying. So all three are business management valuation can have risk if you're not done properly. So overpaying is obviously which is what growth was a year back or towards the third quarter or third quarter of last year. The value we had on our portfolio even a year back, 20-25% across portfolio, subject to the fund manager preferences in the basket which you mentioned, be it banks, some of the banks, and some even metals was cheap, power companies, tobacco, all put together. So 20-25% was sort of there, and the remaining was growth at a reasonable price. So to that extent, let's say banks, it fall in between. It is not. It's neither traditional value. I'm talking of private banks, sort of value types, and neither it is growth at an expensive sort of valuation. So that obviously is very comforting. In many sectors, Chintan, after the correction, as we speak today, are falling in that GAR growth at a reasonable price. Larger pockets like banks, insurance, autos, healthcare, all these would fall in a growth at a reasonable price sort of thing. The excesses are still there, but has been corrected in the consumer discretionary name and staples name by time and price correction. So yeah, I think the philosophy wise, we would say, and again quoting I think Benjamin Graham, that there is only one style, which is value, but you have to buy growth businesses in a country like India. You have to buy growth businesses within it should be subset of value, not traditional value. Traditional value doesn't yield returns in equities, which is a growing asset class. Traditional value means only the asset valuation, that something is worth 100 and you're buying at 40-50 rupees. That's not interesting. What is important is you buy a growth oriented business, but at a reasonable valuation. The top line should grow, the cash flows should grow.
Okay, I think we just have a minute or so. So maybe one last question, and through this last question, I would like to touch two extreme ends of investors. One is a new investor who is looking to enter into the markets, and the other end is someone who is about to retire or who is looking at utilizing that retirement corpus for the regular income. Now, what's your piece of advice to these both extreme ends of investor segment?
Yeah, so I mean, the simple advice may not, because there are advisors and they are well positioned to understand. Actually, individuals, we have to understand the mind frame also, right? So we can't have the age only as a cohort to say that everyone will behave the same way. As you rightly said, that people behave differently. That said, in general, I think there are few important parameters. First is, whenever you are investing in equities, whatever you don't need for medium-term commitments, like don't make it equity as from the returns you will make or meet your needs for next 1 year, 2 year, 3 years. So minimum 3 years, ideally 5 years. If you don't need that money, even if market were to come down by 50%, but you are not disturbed in terms of mind frame, and you take a time frame of 5 years, and you don't need, you're expecting returns from that for your daily sort of thing, that should be set aside. That is the corpus for so even for a new sort of someone who has got a new job, he can set aside his maybe a smaller portion because his daily needs will take larger consumption sort of thing. And surprisingly, someone who is towards the retirement, this pie would be much larger. So it is slightly opposite to that. As you age, you should reduce equities. In fact, as you age, your commitment, because you have very steady sort of other sort of source of income. The point is, what is not needed for next 3-5 years should be put in a vehicle or an investment avenue where wealth from wealth is created. I mean, compounding of wealth is done, and that's best done in equities. So these are, I think, are broadly sort of thing, and also maybe with reasonable confidence, because we are Indians, because we know about the India's growth sort of story, we can make a confidence sort of view that the country will grow at 11-12%. I'm talking of say 7%, 6.5-7% real GDP and 4-5% inflation. So equities will give 13-15% return, say at least 13% returns. So that can be another assumption. So you are confident that over a 3-5 year view, we'll make 13-15% with volatility, but you will make that sort of returns. The second is whatever is excess saving, which you don't need and you want to let it compound in a simple way by investing in good quality business. That should be the sort of other thing. And then individual preferences, time frame, mind frame would be the other sort of factor.
Great, great. I believe we have kind of exceeded our time, and thank you, Neelesh, for sharing your insights. I feel confident that investors would be able to kind of lift their sentiment a bit after listening to you with whatever volatility that they are seeing in the markets on a day-to-day basis. Thank you, Neelesh, for taking out time and sharing your views on the markets. So that's it from our side. Thank you all the participants for joining us. And in case if we have missed answering any of your questions, we will separately reach out to you and answer your questions through email. Thank you very much once again for joining us.
Thanks, Chintan, for inviting me. Thank you.
Thank you.